Good morning, sir. Good morning, classmates. Our topic for today is Introduction to Investment. An investment is an asset or item acquired with the goal of generating income or appreciation. Appreciation refers to an increase in the value of an asset over time. When an individual purchases a good as an investment, the intent is not to consume the good but rather to use it in the future to create wealth. Different types of investment. Investment generally fall under two broad umbrellas, growth-oriented investments and fixed income investments. A growth-oriented investment option aims at increasing the value of the capital over time, whereas whereas a fixed income investment option aims at providing a steady and sometimes rising stream of income that can either be paid to the investors or reinvested while seeking to maintain the original value of the investment. So let us understand the different types of investment under the two investment styles. Number one, mutual fund investment. Mutual funds are financial instruments that pull the money from various investors to invest in security such as stocks, equities, bonds, money market instrument, etc. Returns on mutual fund investment are based on the market performance of the fund's underlying assets. Investor can invest in mutual funds either via SIP or, or systematic investment plan or a lump sum mode. According to the risk profile, investment horizon, and financial goals, an investor can choose from different types of mutual funds available to them. Largely, there are six types of mutual funds, and namely growth or equity funds, liquid or money market funds, fixed income or debt funds, hybrid or balance funds, index funds, and tax savings funds. Mutual funds help investors in achieving their financial goals, be it short-term or long-term. The India Market Watchdog SEBI or Securities and Exchange Board of India has clearly defined each of these mutual fund categories to enable investors to make informed decisions. Stocks, also known as a share or equity stocks, are among the most popular growth-oriented investments. When you purchase a share, you become part owner of publicly traded company and stand to gain a part of the profits. The risk-reward ratio with equity investment is often higher than most other forms or investment. Bonds, also known as a fixed income securities, a bonds is a debt instrument that represents a loan given by an investor to a company or the government. When you buy a bond, you allow the bond issuer to issue you a fixed interest rate in exchange for using your capital. Examples Examples of bonds include treasury bills, municipal bonds, corporate bonds, government securities, etc. Exchange trade funds. Exchange trade funds or ETFs are collection of investments such as shares, bonds, money market instrument, etc. The track the track underlying index. They are a mashup of different investment avenues that offer the best attributes of the two assets, mutual funds and stocks. ETFs are traded on the stock exchanges and are quiet like mutual funds in terms of their regulation, structure, and management. However, one one of the main differences between ETFs and mutual funds is that the former can be actively traded on bourses at any given time during the day, which allows investors to take advantage of real-time price differentials. On the contrary, mutual funds, whether active or passive, can only be bought sold at the close of the trading day. Fixed deposits. Bank fixed deposits or FDS or FDs are among the safest investment option available to investors. They are offered by banks. They are offered by banks and other NBFs, FC, and allow investors to park their idle cash for a specific duration and for a fixed rate of interest. The interest rate is pre-decided and unaffected by market fluctuations, which ensures greater safety of the investments. So from the from the ease from the ease of flexibility to various options offered to an investor, fixed deposits are a boon to risk-averse investors. So, retirement planning, saving for a retirement as well as managing that income once you're retired are two of the most critical aspects of financial planning. There are several types of retirement plans available to investors. Some of the most common investment options for retirement planning are senior citizen savings scheme or SCSS, National Pension System, NPS, Provident Fund or PPF, bank fixed deposit or etc. And investors looking to save for retirement might consider opting for safer investment avenues if they are nearing their retirement. Next is cash and cash equivalent. Cash equivalents strive to protect an investor's original investment while also offering high liquidity. However, they tend to offer the lowest potential returns than other investment types. While they do not generally offer capital growth, they have the potential to deliver regular returns. They can also play an important role in protecting your capital and reducing the risk of your investment portfolio to a great extent. Examples of cash equivalents include times to deposit, overnight funds, liquid funds, high interest saving accounts, bank accounts, etc. Next is real estate investment. The real estate sector holds huge prospect for several industries such as hospitality, retail, commercial housing, manufacturing, and much more. Investors have the option to invest the commercial or residential properties or even real estate mutual funds to earn significant return on their investments. Timing is a crucial aspect when when one considers investing in real estate. One should be mindful that real estate investments can be highly illiquid, or i.e., it might get challenging to sell the property quickly in case of urgent monetary requirement. Next is provident funds. Provident funds, including employee provident fund and public provident fund, constitute constitute the significant part of your retirement corpus. Provident fund is a mandatory government-sponsored retirement scheme that aims at provident employees with a lump sum payment when the employee resigns or during retirement. Last is insurance. Insurance products are often a part of a financial plan. They come in various forms like term insurance, life insurance, endo endowment plans, child plans, etc. Insurance products are developed to meet particular object. For instance, life insurance is designed to meet your expenses as you age, whereas term insurance is designed to aid your beneficiaries in the unfortunate event of your death.